Welcome to episode 191 of The Numbers Game. I'm Jace. I'm joined by Nick and Marty. How are we today, guys?
Going well, Jace. Feeling good. Business is alive and well. We seem to be working a lot harder for it, but that's okay. Sometimes you got to work harder to get a result in this day and age. But feeling good. Nick, how are you, my friend?
Mate, I'm good. I just we were just talking about Guzman Gomez. So you say business is getting harder. People are still spending money on fast food. So for those that don't know, Guzman Gomez just listed, and they put the value of the company at around $3 billion, from what I understand, which is just crazy numbers if you ask me for a franchise business.
Is it good food? I haven't been there.
I absolutely love anything Mexican related. So, I'm all for it. So, although, I don't like to cheat on the place below me in the building that I live does some Mexican food now. So I don't like to cheat on them too much. They're a good little family-owned business. And we are here today talking about business and buying businesses and things like that. I don't want to steal your glory, Marty. But yeah, I don't know if buying a Guzman is what I would want to do. But hey, that's franchises. That's different. But buying their shares, maybe. If they're going to open 1,000 stores Australia-wide and offer some nice, neat, clean, probably one of the cleaner takeaway foods you can get.
Well, let's not steal Marty's thunder, but you brought it up, so I'm just going to let you know what I heard.
Go on.
That apparently these franchises are returning just over 50% per annum as a return to the franchise purchaser. So if you're buying the franchise, I think around 1.5 mil, they must be, if they valued the whole group at $3 billion, then you're probably making $750K a year. I could be completely wrong, but that's what I'm hearing. And you would have to for them to have valued this whole organisation at $3 billion. The numbers must be pretty incredible.
Is that gross or is that net?
Mate, look, I don't get into the intricacies. I just talk high level numbers, mate. I'll just go with headlines. You know that.
It might be 20 grand net profit, fully expensed.
No.
We'll see. The share market will tell us.
That would be net. Otherwise, it's not a return. So.
That's pretty good. If that's net, that's really good. So, but anyway, thanks for stealing my thunder, mate. And let's create some thunder here. I wanted to talk about a guide to buying and financing business in Australia, because we obviously see a lot of opportunities that come across our desk of people wanting to buy, and I thought I'd just talk a little bit about that today, just to give people a bit of a blueprint and format in regards to what to watch out for, what are the opportunities, and you guys, as always, are welcome to throw in any questions left to centre. But one of the key steps I would say is asking yourself, are you business ready? Are you the type of person that's prepared to manage a business, handle the long hours initially, and be that type of person, have the right experience and background. Evaluate your skills. Are you self-disciplined? Do you have a commitment and a resilience? Because, there's going to be some tough times. That's just a given. There's not been a year in business where I've questioned myself twice, where I go, what the hell am I doing this for? And you've got to be passionate enough and determined enough to move through those challenges and come out the other side, because that'll be a repeated thing. And do you have sufficient capital to buy and sustain a business? It's a part of who you are is really important to match a business similar to your own personality type as well, and your own skill sets. And we're probably built for finance in many ways, Jason, Nick, aren't we? It's because we know it, we have history in it. But I think people have to ask themselves that same question when they're looking to buy a business. Wouldn't you agree?
Yeah, no, definitely agree. And having been on the viewing end of seeing many startups, people who go to the effort to start from absolutely bare bones, start from scratch, have nothing, maybe a credit card with 5 or 10 grand, and go through the structures, the website, the branding, the this, that, everything, versus then I mean, the ones that can fast track success by potentially buying a business, the right business at the right price and being able to finance it. So yeah, it'd be interesting to dive into that and unpack that a little bit more with you, Marty. But yeah, seeing both sides of the coin and seeing success and failures on both sides too. It's definitely no clear-cut winner on which way is the correct way to go.
Yeah, it makes you wonder what people think when buying a business. What's the greatest concerns? And I suppose if you're making a significant investment, people are worried that they are, potentially they could burn their money too. But one of the upsides is that, they've got something that's established, that's been around for maybe 4 or 5 years. There's traction, they've got clients, they've got a market, and it's, the benefit of being able to extend that benefit is sometimes, more valuable, and we'll dig in through this, than starting from scratch and really having to build it up from next to nothing. So they're the sort of thought processes you're going around, and maybe you're that type of person. I've always enjoyed, even though it's been really hard, I've always enjoyed building something from scratch. But even coming into Innovate, I've actually loved adding value to something that's working really well as well. So I can see both sides of the fence and you've got to make that decision for yourself. So I think when you're choose the right business for you, you've got to ascertain what's the future business growth potential in that business. Is it a declining industry? Is it a growing industry? Ask yourself, what is your competitive advantage in taking on that business? Are you strong on logistics? Like, could you take out expense and create efficiencies that not only generate potentially higher revenue, but take out more of the cost base and actually keep more of the profitability? And I think that's really important. Ensure you enjoy the industry you're in. Sometimes you've got to have the right personality for the right business, and you want to enjoy it, because when you do have those challenging times, enjoying it will at least move you through that. And even assessing the impact on your family and personal life. I've had so many people over the journey saying, I want to leave my job and start a business because it'll be easier and I get my own time. Wrong. It's you're probably working in many cases, not to sensationalize business, but sometimes you feel like you're working 3 times as hard to get things established, with a lot more headaches across a lot more different contexts throughout the business that you have to get control over. So you've got to think about that impact on your family life, your personal time, and are you willing to make a commitment to making that work? And as you go on and the business is more successful, you obviously get balance coming back in, but that first 3 years is pretty hectic. And the same when you're buying an established business, you really have to be all in that first 12 to 18 months to ensure that it's working for you and you're protecting your investment as well. And Jace, you no doubt would have seen people maybe go in with a false representation on what they think is a great business to what it might turn out to be.
Yeah, definitely. And look, so much happens behind the scenes when you might get presented what it is to buy a business, the assets you're getting, the client list, the day-to-day systems and process of how to run a business. And then that's one thing to be able to look at it on a bit of paper and kind of get a feel and a vibe for it, but then versus taking over the business and getting into the real world. And a lot of people that we see, or I've seen over the years and over the journey, have somewhat bought themselves a job rather than buying themselves a business. They look at it and just go, well, I might be earning $80,000, $90,000 working a wage. I want to own a business so I can make more money and have more flexibility and more freedom. A lot of the time, if you go into a business with that attitude that, you're going to be working maybe not as hard or working less hours and making more money, it's not necessarily that simple and clean cut. As we know from starting businesses ourselves, the amount of hours and effort and energy that goes into getting it right, finding the right people, finding the right customers. Sometimes the mindset before buying a business ends up not being in the right place. And sometimes the reason for buying a business is because you don't want to go through the hard yards of what it is to start. You want to fast track and get to somewhere. But again, if the attitude is to buy a business that you can then improve and continue to improve, you're then thinking the right way. If the attitude is to buy a business because then you can just sit back and just take all the money from all the work that's been done before you come along and you'll just sail into the sunset profitably, probably not going to be that simple. And unfortunately have seen it go that way.
Yeah, Nick, I've always admired the fact that you always wanted to grow a business. And I think in our industry, particularly the mortgage broking industry, a lot of people are very good brokers that are self-employed. And, you know, it's almost a consultancy based on one or two people businesses. And that's absolutely fine. Like if you want to be a consultant, get maximum return on your efforts in servicing clients, I think you've got to make that decision as to whether you want to be a consultant or whether you want to grow a business. Nick, I've always admired that fact. What drove you to wanting to build a business? Because you did start out as a consultant, but you had a grander plan from the beginning. And this is something you've obviously started up with another co-founder at the time. But just give us some understanding around that and how you come to that conclusion.
Oh, for me, it was challenges and internal growth, I guess. If you're, to your point, a consultant, which I think is a very good description, because a lot of people say, I'm self-employed, I'm a business owner. I think they're two very different things. I think a lot of people are just really good at what they do when there's absolutely nothing wrong with this, and they're just really getting paid for the service that they do. But they're not answering to someone, being another employer. So for me, it was the internal drive to continue to do different things in my own life. And when I say different things, I mean in my working life. If you're a mortgage broker, well, that's great, but do you want to be a mortgage broker for the rest of your life? If you don't, then you need to be doing something different. So for me, it was always, okay, I've got a skill, and that skill is being able to advise in mortgages and sell, for lack of a better word, but there's definitely a selling ability there. How do I leverage that? Well, firstly, I leverage that through actually doing the job really well. I understand things inside out. And then from there, I've got a really good baseline or a platform to start to build other people into the business and create or make myself a business owner, and not so much someone that's doing the work and then getting paid a return for that work. So yeah, it was a want to build the business, knowing that I only had a certain time period that I actually wanted to be client facing. But geez, you've got to really want to do that, because I really like what I can't remember which one of you said it, but you think you're going to walk in and I want to be a business owner because it creates flexibility. That's you said that, Jace. That's definitely the case if you're that consultant, someone who's looking after clients yourself, and you've got a few clients that you look after that you get paid for. But the minute you bring in other people to your business, you then need to bring in systems. You then need to bring in processes. You then need to bring in cash flow understanding. You need to bring in sales. You start dealing with everyone else's problems and not just your own. So it does blow up, for lack of a better word, and it does take a particular type of individual to be able to deal with it. And it's not for everyone. So yeah, I think you really need to want to be a business owner, and then you need to educate yourself on what comes with that, because the reality is, at the end of most days in my working life, and Marty, you're the same, and Jace, you're no doubt the same, it's all people. Everything that we deal with every day, in my opinion, bar 10% of it, goes back to people and other individuals that all work together to create the business that we have. Yes, there's capital, and then there's profitability, there's all this stuff, but it all still links back to individuals. So you got to really make sure you want that, because it can be very draining when a lot of the times, even though indirectly it links back to you, you're worried about everything all day but yourself. So yeah, I actually enjoyed that and enjoyed the challenge. But if that's not you, then there's nothing wrong with staying as the consultant and just simply charging for the work that you do, or for the advice that you provide to people.
And that's some great guidance there, Nick, because it's a great consultant doesn't always make a great bigger business owner. Doesn't mean that you can't do it. Absolutely you can, but it's not a given. And the same way the way around, if you've got a great business owner, they're not necessarily always a great consultant anymore because they've been running that high level business. So you really have to assess your own circumstances when you're making decisions around a business. So let me talk a little bit around finance, just to give you some guidance around that. Banks and lenders have more of an appetite to finance quality established businesses because they have proof of concept. So when you're a startup, you've got to produce cash flows on a lot of times speculation. Sometimes you can grade those against existing businesses, but it is a lot tougher. You can do it. There's a lot of work up front and there's more risk to the lender. So if you do get approved on a new business, yes, you probably got to put assets behind it like a house. You've got to do strategic cash flows with your accountant, and there's a little bit of goodwill in that you're going to achieve that. So the banks will tighten a little bit on that, but established businesses that have been around for a while are producing quality profits and revenues and have systems in place, banks will want to fund that. Important things, having skin in the game as a business owner, putting capital towards the purchase is really important. So whether that's you're putting your own money towards it or you're putting a property that you can inject into it. And think about it, some business owners come in buying a business going, I'm not putting my property up or I'm not putting my capital up. I'm going, well, if you're not willing to back yourself, why should a lender back you? This is not sort of angel investing type of scenario. So you got to think about, are you credit worthy? And to give you some indication, let's say you're purchasing a business and you want to go unsecured. You don't want to put your property up, but it's an established business. In most cases, if it's under a couple of million borrowings, you need to put 50% of your own contribution towards that business. So you've got to have the money in cash, or you've got to have equity as security in a property to do that, either commercial property or residential property. Now, if you're doing unsecured debt, your payback, because of the risk factor, it's 5 to 7 years. So again, you've got to think about how that's going to affect your cash flows in regards to doing that. Whereas if you're putting property up, sometimes you can get a 15 to 30 year term. So you're getting longer terms on your payback, which lets you keep your capital in general working capital that you can run the business. Now, if it's over 2 million in lending, and depending on the strength of your personal position and the strength of the business, sometimes we can get more. Like I've had situations where, I funded $3 million, profitability really, really healthy, really strong business, and funded it up to about 75% of the business purchase price. Now that is a unique scenario, but strength in the person buying the business, great synergies and mix on past experience to coming into the business, and the business itself being really, really strong. So that's an interesting factor. A lot of people go into their businesses wanting to fund it unsecured, and then they find that they've got shorter terms and the cash flow is not going to be supported. So something to take into effect. Have you seen that, Jace, with people coming in on lower term debts that cause a bit of a pain point?
Yeah, definitely. And that's where the stress on getting those cash flows and the forecast right from day one, and the ability to get in and get the business humming the same way it was. If you've presented to the bank that, there's $50,000 profit a month, and all of a sudden, you're looking at a good chunk of that monthly profit is going to go to loan repayments, you don't want to have a bad month where, let's say, your loan repayments $40,000 a month and you have one off month and you go backwards, and all of a sudden you're digging into the capital that's required to run the business. So there's a huge element of stress. Yes, you can get the money to buy the beautiful business that's positively cash flowed, profitable, but it comes with the big pressure of knowing, you got to know how you're running that business and how to keep it going. And then to get your ROI or your return on that big risk that you've taken, that giant liability, not only are you necessarily chipping down at the liability, but you also need to be growing the asset value of that business. So even understanding the metrics of how that business was valued to come up with the price that you're comfortable handing over, you then need to be able to go, okay, my plan 5 years from now or 10 years from now is that I want to double the value in this business. How am I going to do that? What are the levers I need to pull to ensure that the asset that I've purchased is growing in value? Because otherwise, again, you've just bought yourself a monthly profit, right? And if your business stays worth the same amount, you're just paying down debt year on year to not have grown an asset. You would have been better off buying something else.
And the whole reason, like you say, you get into business is to create that value. And let's say, you got 200 grand profitability, 4 times profitability, and it's industry dependent this, but let's say it's worth 800,000 that you buy for. Your aim is to increase revenues and increase that profitability to 400,000, which then gives you a 1.6 valuation. I mean, it's very simple metrics and there's a lot more that goes on into it. But what Jace was saying there is what is the benefit and how are you allocating your skills to attain that benefit while you're reducing debt. Because if people aren't thinking about that, then they just going sideways. They could be atrophying the actual business.
Marty, I'm glad you brought this up because it's also a fantastic opportunity for people that have never thought about buying an existing business to have a look at this. And even not just from a startup perspective or getting into business for the first time, but if you currently own a business and you haven't thought about mergers, acquisitions, and, tacking on another business, you might be running a successful business, but maybe the next challenge for you is to buy another business that you can take over, rebrand, put in your systems and processes, put on your magic secret sauce that you've used in your business. If you look at a business for sale that might be valued at a 2 times multiple or a 3 times multiple, but under your model, you can get 5 times multiple of your profit because of the way you run your business. It's not reliant on the owner. It's got good systems and processes and great customers. Straight away, by onboarding the business that you can buy at a smaller multiple, you've made an uplift overnight by bringing that revenue and those customer base into your business. So these are the things to consider that, you may have grown organically to a certain point in your current business, and acquisitions might be the logical next step. I know in the accounting space over the next coming years, the average age of accounting partners now must be in the mid-60s. There's a lot of books of accounting business that are going to exchange hands over the next 5 or 10 years. So it's something that, a lot of people in my industry are talking about, how to go about buying an accounting firm. Likewise, I'm sure in the mortgage broking and financial planning space, probably maybe not as older average age of owner as it is for accounting. And then even any business, that you're in, you can look for other businesses for sale and look for opportunities. There may be someone who has to get out. They've over leveraged themselves. Interest rates have gotten too high and they can no longer afford to keep a good business. So they're offloading it to reduce their own debt, just like people who are going to start selling homes due to facing some difficulties. Business owners are looking to do the same thing, exiting out of a business that's not working in this post-COVID world. So it's a time of opportunity.
It's a great point. There's so many people out there, and you talk about growth, that people have been in their businesses for 20, 30 years. It's a new age of business. They've got it to a point where the business is stable and they don't know how to grow it to that next level, or they don't want to invest extra capital to go to that next level. And then you get people coming through that have ideas and concepts. They're either brilliant on logistics, great on marketing, and really can take something that's a great business already. It's a win for the vendor getting their sale price on it. And then, the next person comes in and optimizes at another level as well. Because a lot of people ask, why would people sell a business if it's doing well? Well, it's a hell of a lot better than selling an underperforming business, right? That's exactly when you want to sell a business, when it's doing well, but just the current vendor just either hasn't got the energy or can't see that next wave of opportunity to grow it. And that provides an opportunity for someone else. And it's pretty exciting when you can see that, even when the current owner is either not interested or is interested, but just hasn't got the skill set or the energy to go to that next level. Talk about great opportunities, right? So very important to take.
So, Marty, if somebody is in the process of looking to buy a business, I know we've got clients that are asking the question to myself now, and obviously, I always refer them over to you. But for my knowledge and for people listening, what are the next steps then? You're starting to look to buy a business. What are the steps to actually go from looking at a business to actually getting the finance off a bank? Is it a complicated process?
Well, definitely in this day and age, it's pretty simple as long as you're meeting the criteria. So to give you some ideas around, having commercial property, let's say you've got commercial property behind you, you can borrow up to 80% of the value on that commercial property. If you've got residential property and you're buying a business, you can borrow up to 100% of the value of a residential property. So those criterias are a lot more flexible than if you're buying a straight home and have to meet certain regulatory things and policy around that. Whereas commercial, you got more flexibility with the assets you have. But if you want the best price on your funding, 65% loan to value ratio on a commercial property and 80% loan to value ratio on a residential property. That's when you hold the majority of power from the asset side of things. And just to give you some scope to around income you need to get funded. So let's say you're property backed, that's less risk to the bank. So if you've got a secured facility, they'll look at 1.5 times interest cover. So I'll just quickly run through it. 2 million of borrowings at 7%, that's 140,000 a year. 30-year term you can get on a property backed deal, 5 years interest only. You need profitability of $210,000. So 1.5 times interest cover. If it's unsecured or partially secured, rates are going to go up because there's more risk, and you need 2.5 times cover. So on $2 million, let's say, probably get cheaper than this, but let's be conservative, 9.95%, that's 199 grand in interest per annum. You're only going to get a 7-year term, 5 to 7 year term. You must pay back principal and interest because it's a risk to the bank. They want to see you deleverage that. So you need to have profitability at 2.5 times of 497,500. So basically on that, you'd have monthly profit coming in of 41,458, and on a 7-year term, your monthly repayment would be 32,688. So it just gives you some dynamics of what lenders look for depending on circumstances. That's why it's really important to get the individual advice up front, because we represent the client in regards to, before we go to the lender, to make sure that they're in a solid position to get their funding approved and work through the individuals in order to get this, done. Make sense?
Very much so.
And I think just the other things in closing up as well, obviously if you're looking for opportunities to buy a business, commercial real estate and business brokers are very handy, but talk to accountants and other business owners. It's amazing what opportunities present when you state your intention that you're looking to buy a business. Not many people think about that, but it's a really good way to go about it.
I think just the last thing too, Marty, is if you're going to do that, as in you think you're going to buy a business, talk to professionals like Jace, because one of the things you need to weigh up, particularly if you are already a business owner and a successful one, is that the best way to go to grow your business? And I know internally here we've made some decisions in our mortgage business that we're actually better to reinvest in our own business to grow instead of trying to buy an add-on, because we're going to get there quicker and we're going to get there easier and we're not going to have to pay for that business. So you really need to weigh up, okay, have I hit a ceiling? And to Jace's point earlier, can I bring a business in and then create more value in that because I'm good at what I do? Or do I simply just reallocate that same money, or maybe less, that I would have used to buy the business, reinvest that into some, in our situation, new staff, new salespeople, and get bigger that way? So, lean on the experts around you to make sure it's the absolute best decision to make, because you go spend $1 million for a business, you're in for $1 million. That's it. You've got to make that work. Versus, could I spend a little bit less, reinvest into my own business, maybe spend $250, $300 and see what kind of return I get for that. So yeah, just talk to the experts is probably the last thing I'd say. Make sure it's the right decision for you.
Great accountant, great lawyer, great broker. So they're the things that you got to kind of stack around you to make sure that, there's something that you may not see that somebody else who has experience in doing this will see for you and bring to the surface just to flesh it out.
Just the last quick fire. Perform your due diligence. Verify the performance of the existing business. Make sure the financial information is accurate. Make sure you get, like Nick said and Jace said, talk to Jace, make sure the numbers hold up. Investigate the business location and the potential for growth. Sometimes location's really important. Understand the lease terms of the property you're operating out of. Have you got 3 years remaining? Can you get an extra 5 by 5 year option on the lease? Or is it just 3 years remaining? How disruptive could that be if you have to shift operations? Is there an opportunity to buy the property in 2 or 3 years' time? What is the current owner intending to do after the sale? Is he going to retire? Is he going to buy another competing business up the road? What's the competitors clause to make sure he doesn't open up down the road? Is the current business owner willing to stay on for the first 3 months to help the transition? How do you ensure you secure the key employee stakeholders of that business? Is it going to be a pay rise? Is it going to give them some sort of benefit in the first 12 months? You got to understand the staff obligations that are existing, the holiday pay that's outstanding, sick leave benefits, all that. And even client risk mitigation. Some businesses reliant on a few key clients. Make sure there's a good spread of clients so the business is going to be solid. Make sure you know in this transition plan how you're going to build great relationships with those clients. Let the current vendor help you do that initially. And just even little things like consider the condition of the assets and inventory included in the purchase, so you don't have to upgrade equipment next week. And talk to someone like Jace and get a 3-way cash flow forecast for the next year, so you've got a plan of attack and that you can get a look at. And the 3-way cash flow is profit and loss, balance sheet, and cash flow working. So know that you're going to get that over the next year. Just quick fire things, licenses, compliance, permits, and from there you can make an offer. Protect your downside, know what your upside is, and get in there and dominate and get good people around you. It's pretty exciting if you get it right, pretty devastating if you get it wrong.
Marty, you've made that sound easy. I'm off to go looking at real commercial and business groups online for some businesses for sale, and I'll be booking a meeting with you so we can have a bit of a chat through all of the due diligence stuff that we have to do. So, mate, I'm looking forward to buying a business. Bring it on. Thank you for sharing everything today, Marty. It's been a great discussion around your options for buying and financing a business. Like every episode, I give you the little reminder, like, share, subscribe, get around it. Any questions for the great guys and girls at Innovate, inovayt.com.au. It's your go-to team for everything that you need when it comes to finance and wealth. Check them out. But until next time,
keep building. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.